In institutional markets, capital allocation is never impulsive. Before serious capital enters any system, one factor is evaluated first: reliability. In digital asset markets, that requirement becomes even more important. Unlike traditional finance, blockchain networks rely on decentralized systems to process transactions, validate activity, and finalize settlements. This structure creates transparency and flexibility, but it also introduces variability. And for institutions, variability must be measured carefully. This is where blockchain network reliability becomes critical. Reliability is not just a technical feature operating quietly in the background. It directly influences whether institutions allocate capital, how much they deploy, and how long they maintain exposure. Because if a network cannot perform consistently under pressure, other advantages, like liquidity, innovation, or yield, become secondary. So what does reliability actually mean? It's more than uptime. Institutional investors evaluate whether a network can consistently process and finalize transactions under different market conditions. That includes stable block production, reliable validator participation, predictable settlement times, resistance to congestion, fast recovery after disruptions. A network that performs well during calm periods but struggles during stress is not considered truly reliable, and uptime alone is not enough. A blockchain can remain technically online while still experiencing delayed transactions, validator instability, congestion-related failures, temporary consensus problems, increased transaction errors. For institutions, those issues matter just as much as downtime itself. Validator stability is another key factor. Validators are responsible for maintaining the integrity of the network. If validation becomes too concentrated or unreliable, hidden structural risk begins to grow. That's why institutions evaluate validator distribution, historical uptime, network participation, performance during high-volume periods, past validator failures or disruptions. Because reliability is not determined by one node, it's the behavior of the entire network under pressure. History matters too. Institutions closely examine how networks performed during previous stress events, outages, congestion spikes, failed upgrades, consensus disruptions, recovery times after incidents. These events reveal how resilient a network truly is, and that directly affects capital allocation decisions. More reliable networks receive larger and longer-term allocations. Less proven networks may face tighter exposure limits, smaller allocations, or additional safeguards. Because in institutional frameworks, reliability comes before opportunity. Liquidity only matters if the network works consistently. Yield only matters if settlement remains stable. Execution only matters if transactions finalize reliably. At Kenson Investments, blockchain network reliability is treated as a foundational component of capital allocation strategy. The focus is not just on opportunity, but on whether infrastructure can sustain performance when market conditions become difficult. Because in digital asset markets, reliability is what allows every other market function to exist. If you want to better understand how institutions evaluate blockchain infrastructure before deploying capital, visit kensoninvestments.com and connect with the team today.